This is a brief introduction or outline to give you a framework of trying to make sense of the recent events and what's going on at the moment. It's not a 10-week course in international finance or anything like that. It's just sort of a loose framework to give you some sort of idea of what sort of all the things that are being talked about in the media and on the news mean at the moment. So, slide. A couple of quotes there. Head of equities at a large UK bank last week to the Financial Times. It feels as if we are 15 minutes away from the end of the world.
Bring it on.
Bring it on, yeah. Absolutely. And our good old favourite, George W. If money isn't loosened up, this sucker could go down. Love it. Slide.
Did he say that last week?
He did. He said that at this famous meeting where they got everybody together on Thursday, where Congress thought they'd cut a deal, and then your man McCain arrived back and fucked it all up. But anyhow. Right, the scope of what I'm going to try and go through is to give us some ideas to answer some of these questions, like what is the nature of the crisis, what's the mainstream debate about, which is whether the crisis is, the nature of the crisis, is it a liquidity crisis or a solvency crisis, what do those terms mean, and then what would an anarchist interpretation of the nature of the crisis be. Then, seems a bit back to front, but it sort of makes sense, at least in my twisted mind anyway. Then looking back to the origin of the crisis, talking about its origins, the toxic loans, credit bubble, and so on. And then trying to situate that in the bigger picture. Slide. The final part of the scope is obviously looking forward. There's no point looking at these things unless we're going to apply that into the future. So the questions are, what next? This Paulson plan, what is it? Will it work? What does it mean to say, will it work? Strategy-wise, going to do something called a SWOT analysis, which is something we use in the corporate world, called Strengths, Weaknesses, Opportunities, Threats. It's an acronym. SWOT analysis for capitalists, and one for us, of course. So, I'm not going to give you sort of banking 101. I want to talk about just a couple of ideas to do with banking to understand what banks' problems potentially be. Fractional reserve banking is the idea that when you go to a bank and deposit, say €1,000, they have to keep a fraction of that in reserve, say 20%, but then they can take the rest of your euros, your 800 odd, and lend it to somebody. But the really good part is the person that you lend it to then goes, what should I do with this money? I know, I'll put it in a bank account. And puts it back in the bank with another account. So you then take 20% of that and lend it out. So you can lend out the same money again and again, keeping the fractional reserve behind. And that's how banks create money. That's what credit means, is basically you're taking the money from the start and you're multiplying it into more money. This is vital to the functioning of the capitalist system, of the money system, that we have credit. You know, nobody is going to earn themselves a roof over their head, brick by brick, slate by slate. That's not how it works. Next question then is, what is a bank run? One of the problems with fractional reserve banking, of course, is that everybody turned up on a given day and said, I want all of my money from my account given to me right now, please. The bank can't do it. And throughout the 19th century, you had every 10 or 15 years, throughout the whole century, you had these banking panics where people would suddenly, the rumour would go around that, you know, there's various financial problems, bad news stories, then certain bank, looks like it's going to go bust. And people would rush down to the banks, and there'd be these huge mauling rucks outside banks, people queuing up, desperate to get their money before the bank collapsed. There was Frank Capra's film, A Wonderful Life, shows sort of an example of a bank run. Something that we thought we'd left behind in the 19th century and 20th century until this year in Dublin, and of course in England, people queued up outside the Northern Rock for exactly the same thing. It was the first bank run in Western society in our times. So, these questions: what is liquidity? What is solvency? Liquidity is if you won the national lottery, they gave you a big cheque for 10 million euro. You walked into the bar and said, "I'll have a round of drinks with my friends." They said, "Fine, that'll be 30 euros, please." You said, "I've just got 10 million quid." It's like, that's very nice, but I still want my 30 euros, otherwise you're not getting a drink. Liquidity is about your ability to service your cash flow, regardless of how much your business is worth, etc. like that. Some things are more liquid than others. That means they flow easily. Money is very liquid. A house, for example, you may own a house, you may have a mortgage on a house, but it's no use on you unless you can sell it. And at this day and age, that's not so simple. So these are extremes of liquidity. You can be solvent, i.e. your business can have, in theory, enough assets and enough equity to cover your liabilities. Sorry, I better explain those things. Assets are things that you have which bring you money. Liabilities are things that you owe to other people. And it's quite important to remember that in the financial world, one person's asset is somebody else's debt. And your debt is somebody else's asset. So liquidity means that you can be basically solvent but have a problem servicing your cash flow. Solvency is another matter altogether. Solvency is because of the problem, the ability of banks to create credit through this multiplier effect. There's a possibility of overreaching. Too much of a good thing can be a serious problem. So after a century and a half of various crashes and so on, all governments now regulate banks in an attempt to try and keep them solvent. One of the ways originally they used to say, okay, you have to have a certain amount of all of your deposits as a currency reserve. Since the introduction of central banks in America in the early 20th century and really throughout the world after that, where the central bank becomes the provider of cash of last resort in the event of a bank run, that's moved now to something called capital adequacy ratio. Now the important thing about capital adequacy ratios, banks are unlike other organisations, if you like. Most of their assets, most of the things that bring them money are loans or debts. And with every loan or debt, there is a risk that the person that you've loaned it to, or the debtor, could default. That's called a credit risk. So obviously some loans are more dodgy than others. And what happens with a bank's asset, basically you take your various assets and you apply a multiplier to them depending on their risk. So where you've got a big stack of cash, that's zero risk. So you times your big stack of cash by zero. Then if you have bonds, for example, that represent debts from a large company like IBM or somebody that's relatively secure, although in these days no one knows exactly who that is anymore, that you might apply that, you say that would be a very low risk rate, so we can apply a multiplier of, say, 0.1%. Sorry, 0.1 to that. If you have a very risky thing, that might be 1. So for every dollar you have out in that loan sum. The important thing is, then, that multiplies up to a total, which is your risk-weighted assets. And that is matched against your capital reserves. Technically your Tier 1 and Tier 2 capital, which basically boils down to the amount of money your shareholders paid to buy their shares. It's not the current value of the shares in the stock market, it's the actual money they handed over to start the bank. Right, so you'll hear these terms, and that's important. The total amount of Tier 1 capital you have defines how much of these risk-weight assets you can have. And if you get more than that, then technically you're insolvent. The government send in the regulators, take over your bank and shut you down. So it's very important as a bank how you balance your books. And the important thing here is the amount of assets you had, and more importantly, we're going to see later, how risky they are, what multiplier types of them. Right. A solvency crisis, as I said, really as a bank is when you go bust, is when your balance sheet blows up. Slide. Derivatives. I'm not going to go into derivatives in too much detail because I'm rather hoping that some of you at least will have read my previous article on Red Black Revolution on derivatives, or if not, you can go and read it. But I'll just review the important things that are important for us to tell this story, if you like. So derivatives are artificial financial instruments that derive their value from some underlying asset, be they stocks and shares, bonds, exchange rates, loans, indexes, mortgages. They come in various types: forwards, futures, options. That should be swaps, actually, not bonds. Mea culpa. A swap is the one that we're going to be interested in particularly today. The most important thing about derivatives, which makes them powerful but dangerous, is they do not require any ownership of that underlying asset, which allows you to do two things. It allows you leverage, means you can pretend you can get the income from having lent $10 million to IBM without lending IBM a penny. Very nice. Cheap, nice entry price, no money down, easy terms. And also it's good for evasion. It means swaps, for example, were originally invented to evade Keynesian currency capital controls that stop people moving large amounts of capital across borders. You just phone up your business compere in another country, say, I'll swap you this for that. No money changes hands. No transfer of ownership on anything. No government can tax anything. No transactions taking place. It's also very difficult to see because it doesn't pass through any exchange anywhere. This is called over-the-counter, which is where you put a transaction directly between two people without necessarily anybody else getting to know. The vast majority of the derivatives market is actually over-the-counter market as opposed to exchanges markets, that's why things are so difficult to see. The uses of derivatives, uses are hedging, which is protecting yourself against risk. Again, I won't go into that too much. Arbitrage. You can also, anything that you can hedge with, anything that you can protect yourself against risk with, you can turn around and use to gamble with as well. So rather than selling your risk, if you have a risky position, like you're a farmer planting a crop, you don't know what price you're going to get paid for your wheat come harvest time, you can protect against the risk of that price being low enough to ruin you by buying a future or an option at a set price with a dealer. And that protects you against the risk, or rather it moves the risk onto him. So if you come to market time and the price of wheat has dropped through the floor, you're all right because you're covered. However, the person that sold you the future has to take the hit. So basically, you're moving the risk. When you buy an option or a future or so on, you're paying them to take your risk away, and they're taking your money in return. Obviously, you can turn that around and say, well, I've got lots of money, not many opportunities, I'll take a gamble. I'll take on other people's risk, so they just pay me money, gambling the fact that the bad outcome won't happen. Which is fine, of course, until the bad outcome does happen. To use an analogy with derivatives, use a musical analogy, if you like. Traditional financial instruments have one purpose. Bonds do one thing, they have fixed incomes. Equities have variable incomes, they allow you certain amounts of political power over the company, etc. But a bond can't do what a stock does, and a stock can't do what a bond does. Derivatives are like the synthesizer. You can do anything with a derivative. You can put them together in a certain way to shape your waveform however you want, which is great. But you can also you can make things that can't be done with traditional instruments. But you can get yourself in a lot of trouble as well, and not just... Credit default swaps are the particular kind of derivative that we're going to look at in our story of figuring out what the hell is going on today. So, the slide is a clue. move on. What is credit default swap? Credit default swap is, again, you're paying someone to take your risk. Now, the idea is, in theory, if you loan some money to somebody, a company, a hedge fund, whoever, it doesn't matter, you loan them money. In other words, you buy their bond. You want to protect against the problem of, say they go bust, go into receivership, which means they don't have to pay anybody, they owe anything, and you're out of pocket. So what you do is you go to a seller of protection, and you say, I want to buy a credit default swap against this person here going bust. They're usually bought for 5-year or 10-year fixed-term contracts. And this protection seller will look at, the reference asset and go, well, I think they're pretty safe, so I guess you will pay me quarterly LIBOR plus 30, for example. LIBOR is the London Interbank Offer Rate. That's the unofficial, that's the non-state regulated interest rate that banks charge each other in interlending. We're going to get on to what the money market is and how the interlending market works in a minute. But just accept there's something out there called LIBOR, which is the interest rate at which banks lend to each other. And just about every kind of financial instrument these days is priced in relation to LIBOR. So you'll say, you put a spread on it, basically, which is measured in basis points. It's 100 basis points to a percentage point, which gets over the confusion of saying, I had 10% and then it increased by another 10%. Is that 11% or 20%? With basis points clear, I had 10 basis points increased by another 10 basis points. That's 20 basis points. 0.2%. So, say 30 spread over LIBOR would be the LIBOR exchange rate plus 0.3%. And you pay that for the duration of the term, for the 5 years every quarter. Now then, should a defined credit event happen, which could be the firm going bust, it could be their rating from Moody's or Standard & Poor's going down, it could be them being restructured in some way, etc. You define in the contract at the beginning what constitutes a credit event. If one of those things is triggered, then your protection seller has to pay you back the value of the notional bond that you took out. So you say, I want to protect the equivalent of 10 million, right? Which is, it's called the principal. Bearing in mind, actually, you may not have bought anything at all. This is the nice thing about derivatives. You don't actually have to buy anything, apart from the protection. When that default event happens, that person there is going to pay you back. But not going to pay you back, well, there's something called physical settlement. So if you actually give them a bond from that of 10 million, then they have to give you the 10 million. But most people don't buy the bonds. Well, this is cash settled. So you find out what the bonds of the company are now that it's had this credit event, and it may be 20p on the pound. Sorry, totally still again. 20 cents on the euro, for example. Well, that means then that your seller should pay you 80 cents on the euro. So if you bought 10 million, that's going to be 8 million that they owe you. Slide. Now, they get more complicated than that, but that's the basic idea. And this is a derivative that is specifically to do with credit. We've got a lot of other derivatives out there which protect against insert rate swaps and stuff like that. But because this is about expanding and potentially shrinking money supply, this is a much more dangerous one. To give you some idea, as 10 years ago, this stuff didn't exist hardly. The year 2000, the notional values, that is to say, the add of all the principals, they're actually worth less than the principals. But anyway, how much less is an interesting question. The total notional value in 2000, the CDS, was $630 million. By 2007, it was $62 trillion. So that's 100-fold increase in 7 years. This shit has exploded. Just to give you some idea, well, I'll go into why. I've got another slide somewhere to give you some kind of idea. $62 trillion, by the way. The gross domestic product of the United States of America, that's everybody in the States, everything they earn, the rest of it, is $13 trillion. The entire gross domestic product of the whole fucking world is $54 trillion. 62 trillion. So, why did these things go from zero to bigger than the gross domestic product in the world? A couple of things. The collapse of Enron in 2001 and the subsequent collapse of WorldCom made the case because, in fact, the reason why those collapses didn't bring down as much as people thought they were initially going to bring down is because the people who were exposed to them were covered by credit default swaps. Everybody watched these guys and thought the world was about to collapse and saw these guys getting paid out and thought, wow, that's cool. So everybody got into the CDS business. Sounds good. In fact, once everybody gets in, if you don't get in, then, you're exposing yourself to risk that nobody, in a way that nobody else does. So you're crazy not to. There's a sort of mass thing. Once the market has started going, people found other uses for these things. It's the law of unintended consequences. We get back to our banks and risk-weighted assets. As you remember, once a bank has lent out its maximum assets, risk-weighted assets compared to its capital ratio, that's it. It can't lend any more money. However, should it decide, I'll take some of my riskier assets here, and I'll buy CDS swaps to make them less risky. I'll sell the risk from those assets. Guess what? Those assets, risk-weighted, compress down. Great. Now you can go out and make more money by making more loans and so on. So, of course, all the banks decide, well, this was a classic idea. So they all massively invested in CDSs to compress their balance sheets so they could make more money, which was sold to them by insurance companies like AIG, for example. And there are a few other uses that we'll get to in a moment. Structured products. Let me see my slides here. Got more structured products. Yeah, structured products are basically... I have got a slide on this further down the line. So, yeah, we'll go more on that. Next slide. Right. Just so I didn't... Hedging. In the old days, in order to secure what your money was owing you, you could go to an insurance firm. Say, I have a contract with firm B, blah, 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 can't insure the contract. Fine. Great. Problem is, what if you know that firm B also has a supply line with firm C that you don't have a direct connection to? But if firm C goes down, that's still going to cost you a whole lot of money. Because you're still going to have to find another supplier, you might have to retool, etc., blah, blah, blah. But because you didn't have direct contact with them, there wasn't really any way of protecting yourself against their credit events. The great thing about CDS thing, its legitimate use, if you like, is that particularly in a world with globalization where you've got supply chains getting longer and longer, crossing national boundaries going around the world and so on, is that now you can get protection against people who may be the other side of the planet that you may have no direct connection to, but if you know that if they go down, that's going to have a knock-on effect that's going to hurt you. So that's the legitimate thing, if you like. Problem with derivatives is, again, linked to the fact that you don't need to own the underlying to get a derivative on it. And that becomes a problem because, of course, after a little while, you end up with more derivative contracts than there are underlyings. So for every $10 million firm A has loaned to somebody in the world, there might be 10 contracts out there of people saying, well, I've just bought a contract as if firm A has lent me $10 million. That's great until firm A goes bust. Because if firm A went bust in the old days, somebody would be owed $10 million. Now, collectively, somebody's owed $100 million. Uh-oh. That wasn't too smart. So, basically, the idea is when the shit hits the fan, more shit actually comes out of the fan that flew into it. So, risk-adjusted progression we've talked about. Naked shorts. This is shorting that has officially been banned, of course, which would be a nice idea, except, of course, you can do it with CDS. You know, if you think a value of the company is going to go down, you buy CDS on them. If they get into trouble, then obviously the danger of them going bust increases, the value of your CDS increases. But it works the other way around as well. If enough people buy CDS, it pushes the value of CDS goes up. All the long-term investors go, oh shit, that firm's in trouble, so they sell all their shares, and the share price goes down. The share price goes down, the ratings agencies goes, oh shit, that firm's in trouble, we better derate them. When they derate them, it gets more impossible to get money, and the firm really is in trouble. So CDS are a great way to force firms out of business. I'll play it that way. And just taking a basic punt on a company going bust. You know, there was a complaint by a company director sort of in the last year or so, reported in the press saying, like, you know, when we get into trouble and we sit down at these meetings, restructuring meetings with our creditors, our main problem is we don't know who of the people sat around the table is actually holding CDS positions, which means it's in their interest for us to go bust rather than see us get out of trouble. Nobody knows anything. Nobody can trust anybody. It's like, this is just my gratuitous naked shorts picture. It's like, structured products. I'm going to rush through this because I can see your eyes blazing over already. But anyway, the whole idea of structured products is banks don't make nearly as much money by holding loans and waiting for payments to come in as they do arranging loans in the first place and making the deals. So, of course, once they've made all the loans and they're sat there waiting the money come in, they're like, gee, I wish there was a way of getting rid of these loans so we could keep the money coming in, but go out and make some more loans. And that's what CDS allows you to do, because it allows you to take the risk. In the old days, the whole idea of a bank was you make the loan, you keep the risk. Now you can sell the risk to somebody else. Still keep some of the income streams, but go out and make other loans and keep passing them on. The way you do this is you set up things called special purpose entities or conduits, usually in offshore places like Cayman Islands, tax evasion. U.S. tax law says that you can't have international bodies trading or brokering into the States, but you can have them investing. So U.S. banks can sell, it's got to be a true sale, written, signed, sell these things to a specially set up company in the Cayman Islands that would then create these structured products with them. Structured products work basically, call it pool and tranche. You take a whole load of loans, you pull them all together, you do some complicated maths with them, and then basically you put them into three sort of offerings, if you like. You have a top level, low rate, not too high return offering, which is your senior tranche, which you then go and bribe a ratings agency to go and say, that's AAA, solid gold, risk, tranche and credit stuff. You have, at the bottom, you have some very poor, some high risk but high yield equity tranche, and in the middle you have called the mezzanine tranche, which is the stuff in the middle, which you usually get rated about B. You don't bother rating the stuff at the bottom. That's junk bond stuff. But junk bonds are popular because they're very high yield. So they've been renamed as high yield. In fact, it sounds better than junk. But the whole point of this, as well as your tax dodges, you're mixing in, you're creating a mix of solid low-risk stuff with some more exciting, racy, slightly higher risk but higher return stuff, and parceling it out. And the way you do it is you say the people at the top get paid before the next people down and so on. So you create a first class, second class, third class service in terms of who gets paid when. This is such a cunning idea, they've done it all over the place. Collateralized debt obligations is one of these. Again, taking a lot of loans like mortgage loans, pull them up, tranche them out, sell the high tranches. Couldn't figure out what to do with the middle tranche. No problem. Take a whole load of middle tranches that you couldn't sell, pull them back up, tranche them up again, and sell them back out. That's called CDO squared. Even better, you don't even have to have mortgages. As we say, the great part about derivatives, you don't have to own nothing. So you have things called synthetic CDOs, Well, you don't even bother buying the mortgages. You say, hey, pretend I had these mortgages. You buy these things, I'll pay you this much twice a month, and that's a synthetic CDO. A synthetic CDO squared. And cubed, haha. Slide. So, how the fuck do you price this stuff? One of the reasons CDOs took off in 2001 is some clever quant chap called David X. Lee, don't know what the X stands for, fuck knows, came up with this idea, this Gaussian copula. So you can see, very simple. These big, did pi minus 1. You understand? Yeah. Mind you, these are just for the cash CDOs, not synthetic CDOs or CDO squared. So if anybody can work any of this out, by the way, there's a certain Mr. Hank Paulson in Washington who would love to hear from you right now. Name your price, because they sure as hell would like to figure out what these things would be worth. Gavin, if you want to take a sabbatical from your thing, get to work on this math, they'd love to hear from you. Slide.
We're going to buy some of that stuff.
So, Willie Sutton. Willie Sutton was he was born in an Irish neighborhood in Brooklyn, Irish-American family, and he didn't really hang out with any of the mobs in the 20s and 30s, but he was a very notorious bank robber. He was famously attributed, a reporter once asked him in the 30s, said, Willie, why do you rob banks? Willie said, because that's where the money is. It's a great line. It's been misattributed to John Dillinger and and various other people as well. The great thing about this quote is that years later, Willie, after he finally got out of prison and had his memoirs ghostwritten, claimed that he never made it. Said the reporter just made it up. The other thing that's interesting from our point of view is that nowadays, this is not actually true anymore. So now we're going to talk about, slide, the shadow banking system. I couldn't get the shadow screen, unfortunately. Which is where a good part of the money is. Slide. What is the shadow banking system? We've talked about why banks don't make as much holding loans they do from creating them. Hence the idea, let's offload the buggers. Economists can then make them into wonderful instruments that nobody can actually understand or price, but as long as they keep expanding, everybody's making more money than they'd be able to make from anything else. Supposedly at AAA ratings, must be good. The very banks that actually originated the loans that they sent to the CDO that they then turned from shit into gold, can now buy the AAA ratings that they get a higher return from than the original loans. Everybody's happy, right? So we need to talk about the money market. What is the money market? The money market is, partly it's the banks, the traditional banks. But they're actually only about half of the money market these days. The role of interbank lending, my previous talk on derivatives and my article explains sort of the origins of the euro-dollar market out of the Cold War and how this stateless money started floating around, creating this interbank market. We're not going to focus on too much of that now. But out of that, of course, comes the LIBOR. Who are the players in the money market? Mutual funds, specifically a type of mutual funds called the money fund, which is basically where to keep your money if you're rich. Banks are for little people, yeah? You know, only schmucks like us have bank accounts. Really rich people do not leave their money in an AIG account or something like that. They might have a small one for petty cash, but where Dermot Desmond keeps the 750 million euros is not in the AIG. He keeps it in a money fund, which is basically a fund that you buy, and they keep the shares at $1 per share. So that, you know, so, okay, I've got $500 million here, I'll buy 500 million these money market shares, and then they use that money to play in the interlending market, to buy treasury bills, to buy bank drafts, and so on, and to play in the money market. And they give you a higher return, of course, than we ordinary poor schmucks can get in our current accounts. because obviously if you're rich, then you deserve to get more money. Makes sense. SPVs, we talked about. These are these conduits that the banks offloaded their stuff on that are technically independent. Hedge funds are basically mutual funds, but sort of under the radar, who evade the regulation. In 1940, it was still a bad time for finance. You know, the Memories Depression was still pretty high. There was a war going on, all that sort of stuff. The U.S. brought in regulation that said that mutual funds couldn't short sell, for example. So in 1941, a fellow set up a particular fund which had 99 members, which meant it was less than the 100 members that the regulation kicked in at. That meant it was fairly unregulated, was able to do short selling and all sorts of other sort of stuff that regulated mutual funds can't actually do. So they're kind of like the buccaneers or the anarchists of finance, if you like. They break all the rules. That's how they make their money. And investment banks, which are now history, in fact, as of last week. But we're the big, and after the Depression, America said, as a fail-safe device, we're going to divide banks into two. We're going to have those banks who take ordinary people's punters' money and look after them. They're called commercial banks, or in England we call them retail banks. Or we have what's called investment banks, who deal specifically with underwriting corporate issues of shares, things like that, providing capital market services to corporations. Ne'er the twain shall meet. This was institutionalized by a thing called the Glass-Steagall Act, which was finally repealed under Bill Clinton in 1999. We still had people like Morgan Stanley, Merrill Lynch, Lehman Brothers, Goldman Sachs, and so on were investment banks up till a couple of weeks ago. With all the shit that's hit the fan, obviously, Bear Stearns is dead. Well, he got bought out. Lehman is dead. Merrill Lynch went into the arms of Bank of America, commercial bank. And finally, the last two survivors, Morgan Stanley and Goldman Sachs, just last week signed on at the Fed to be regulated banks, in return for which they get access to the Fed's lending window, the lender of last resort. What's the size of the players in the money market who are not banks, or who used to not be banks? So you've got these conduits added up to about 2.2 trillion. That's included asset-backed paper. 2.5 trillion repo market. Repo market is basically where banks need funds overnight for a short period of time. They say, here, I'll give you my treasury bills in return for the cash, and then we'll make an arrangement for me to repossess those bills in a day or two to hand the cash back for the bills back. They're kind of screwed at the moment because the money markets are saying, going into the deal, saying, yes, we'll take your treasuries for cash, and then they're keeping the treasury bills and not giving them back. So that's screwing the repo market. 4 trillion combined brokerage assets, that's Goldman Sachs, Merrill Lynch, etc. And 1.8 trillion hedge funds. So it's about 2.5 trillion in 2007, which is roughly about the same as the regulated bank. So the shadow banking players in the money market were about half the banking, half the size of the market again. So, again, these figures for comparison, GDP 13 trillion, 54 trillion. Right. Yeah. This is kind of a slide. I didn't know quite where to put in this, but this is some idea that even within the institutions of capital, there are people who are not entirely sold on the neoliberal doctrine that we've had right up until now. This guy called Hyman Minsky, who was a Keynesian of sorts, radical Keynesian, he came up with this idea that financial capitalism is inherently unstable, in the sense that the longer you go on without any major issues, the stupider people's bets become, until eventually it blows up in their face and there's another crisis. This chap here, Paul McCulley, he works for this guy here, Bill Gross. They work in a firm called PIMCO, which is Pacific Investment Management Corporation, which runs the biggest bond investment fund in the world. So they're kind of fairly, they're not outsiders, if you like. Paul's a big fan of Hyman. He actually coined the phrase the Minsky moment, that you might even have heard if you, has gone out, spread through the newspapers, and, you find even the occasional TV presenter saying it, which is this basic idea of this turning point where the really stupid bets suddenly go bust and everybody goes, oh shit. He also coined the shadow banking term, which is what we're using. And he coined that last year at the just before the federal get-together that they have every year in Jackson Hole, which is hosted by Kansas City Fed Bank. And by the time it got to the summit in Davos, the World Economic Forum, Bloomberg TV actually broadcast the big debates they have with finance, and me being a sad bastard, I actually watched it. But by that stage, everybody was using the term, what are we going to do about the shadow banking system? Because that's basically the part of the system that is in full-out collapse at the moment. Bill Gross had this wonderful theory, which is similar to Minsky's as well, which is called the plankton theory, which is rather insulting. But anyway, it's this idea that all life in the sea is based on the plankton at the bottom. So right up to the biggest whales, killer whales, and so on and so forth. If anything goes wrong to the plankton, then eventually everything up the food chain is going to buckle up and die. And he was saying this is basically equivalent in a property market to first-time buyers. If you create a property pyramid where the price of property goes up and up and up and up and up until the people at the bottom, the first-time buyers, can't afford to buy it anymore, it goes pop. It's pretty common sense, really. And I would suggest that's kind of where we are now, certainly in Ireland and England and so on. Right. The current crisis, where we are now. The background, the lead up to it. Alan Greenspan was head of the Fed, which is the central bank of the States, from the mid-'80s until 2006. He's famous for something called the Greenspan put. A put is where you sell something on the market, and a call is where you buy something. This is basically that any time there was a problem in America, whether it was the 1987 crash, Desert Storm, anything where shares started to go down, he would lower the interest rates, flood the country with money until share prices went back up again. This greatly pleased people who own shares. And, of course, all the people who work in that industry. The downside of that is that if every time there's a problem, you put things off by just lending more money, you certainly wouldn't want to allow your children to run their finances this way, for example. You're just putting stuff off for a bigger and bigger problem further down the line. This all came, particularly after 9/11, we were sort of coming into a bubble burst anyway, because there'd been a bubble around tech stocks. Everybody thought that somehow computers had changed the laws of the universe, and anybody who had a web page was going to make, millions of dollars somehow, magically. Damn, yeah, we tried. And that was going pop, and then some Quran lovers flew the odd airplane into the World Trade Organization, and there was all kinds of shenanigans going on, really. So he basically jacked down the interest rate pretty much as low as it could go, and kept it there until about 2004. Great stuff, lots of money everywhere. Obviously, the people with large amounts of money always have the big problem, where do you put it? And I don't mean where do you keep it, I mean where do you put it so that it makes more money? Big problem, America doesn't make anything anymore. So, yeah, property, if it's the only thing going, put it into property. And the outcome, as we know, is we've lost various investment banks. Boo hiss. Oh, shame. Fannie Mae and Freddie Mac, which were the government, originally they were government enterprises that underwrote ordinary people's mortgages. They were then hypothetically, from 68 onwards, they were hypothetically private, but in fact they weren't, so they've now been taken back onto ownership. So. And all the stuff that's happened in the last week. after bailing out Bear Stearns and bailing out Fannie and bailing out Freddie, the geniuses in the Treasury and the Fed decided that it was going to look pretty bad if they didn't let anybody go to the wall. So finally they decided, well, probably Lehman deserves it. And by the way, Hank Paulson is an ex-CIO of Goldman Sachs, not of Lehman Brothers. Important. Downside was Lehman was very heavily involved in the CDS market. Big problem. So it goes down. In and of itself, there are all the people who got CDSs against Lehman going down. Then there are all the people who've been paying Lehman for CDS against everybody else going down, go, whoa, wait a minute. AIG got pulled down by Lehman. They lost out so much on Lehman that this is actually quite funny. AIG is an insurance firm. It's a very big insurance firm, tens and tens of thousands of people. But what brought it down was a small office of 327 people in London who weren't part of the insurance business at all, set up as AIG Financial Products. They got into CDSs. Great. And they set themselves up as a bank and as insurance so they wouldn't be regulated. They sold CDSs to every fucker. Every bank in the world. You want to compress your rents? Come to us. No problem. Great stuff. You don't have to spend anything. There's no initial outlay. You just get paid. Fabulous. They were making $3 to $4 billion a year for AIG. They were the most profitable sector of AIG. Well done, those people. Downside is, obviously, in the last year or so, when things have gone the other way, and all of a sudden, when you turn that 10 million into 100 million, it works really badly with the other way around. When you turn your losses from like $1 million into 10 million, etc. They started to incur, and they were having to draw on the finance of AIG, which eventually meant that at the beginning of last week, AIG had to post, I think, something like $14 billion as collateral to the loan, which they were having problems getting. And then after Lehman went, they were going to go down another downtick, which meant that $14 billion had to go up to $240 billion, which they definitely didn't have. Downside was that if AIG went down, every bank that had compressed their balance sheet with AIG insurance was bust. All of them. Uh-oh. So obviously AIG got nationalized because, hey, seriously, guys. The downside of this was, because Lehman went down and AIG got nationalized, Reserve Prime Fund, which is a money fund, is actually the original money fund, set up by the guy who invented money funds, did something called broke the buck, which is all those rich people who got their shares in for $1 a share. All of a sudden, those shares are actually less than $1. Oh, big panic. Because, of course, while the stock market's been going down for the last year, everybody's going, well, let's get the fuck out of equities, let's put it somewhere safe, like a money fund. Now, if the money funds aren't safe, what happens next? Major panic. And that's what dragged HBOS down, and that's what dragged them into stabbing him like, okay, we're going to stop everything here and buy whatever it needs to buy with taxpayers' money. It's like, so that's just a nice little demotivator contribution for the lame side. See the security man looking at the guy there, trying to figure out whether he's the guy who's lost him his job. So, slide. Getting back to the questions we laid out at the beginning. What is the nature of the crisis? The official story from Paulson, Bernanke, and the idiot, George W., is that it's a liquidity crisis. Nobody's in any real trouble. It's just they have all these assets on their hand, these bad paper, the CDO, asset-backed commercial paper stuff that nobody knows, even with Gaussian copula, nobody knows what it's worth. Because nobody knows what it's worth, nobody's willing to trade. So they reckon that they just suck all this poison out of the system, then everything will be fine again. So they're saying, it's just a liquidity crisis. All we have to do is take all this stuff, put it into a big pit of poison called the bad bank, funded by the taxpayers, yay, and the rest of the world, because, of course, we'll be buying the U.S. Treasury bonds to support all of this, that will cure the problem. People who disagree with this include just about any credible economist going, really. From Financial Times, Wall Street Journal, people like Nouriel Roubini, who's made a name for himself. He's been a prophet of doom for years. Of course, now everything he said has come true. They're queuing up to invite him to their dinners. A guy called Luigi Zingales, who Martin Wolf from the FT quoted, who's an interesting fellow, wrote a book called Saving Capitalism from Capitalists, which tells you where he's coming from. But these are all, none of these guys are particularly left-wing. These two, okay, they're sort of Italian sort of champions of capitalism, which means by U.S. standards they're all a little bit commie. But, certainly no one could accuse the assistant editor of the Financial Times, Martin Wolf, of being a commie in any shape or form. But they just don't agree there's a liquidity crisis. They say the basic problem is it's leverage. We used to have a system where the average amount of equity to assets in the banks was, according to Basel II regulations, it's supposed to be a minimum of 4%, more like 6%, or 8% for Tier 1 and Tier 2. Now, to give you some idea, Goldman Sachs, for example, until last week not officially regulated bank, but nonetheless, went from 1998, I think they had, they had a leverage of about 8 times, if you like, of equity to portfolio. And then 2007, last year, they'd gone up to having equity of about 40 billion and a portfolio of 1.1 trillion, which is leverage of 25 times. A number of these things that we've seen go bust over the last year have been leveraging up to 30 times and 35 times their capital. The big picture for the United States is that household debt, that's ordinary punters' household debt, has gone from 50% of GDP in 2000 to 100% of GDP last year. Debt as a percentage of GDP by financial institutions, that's not just banks, that's all of these devils, has gone from 20% of GDP in 2000 to 118% of GDP. So we see an enormous explosion of leverage. And this is what the same people say, well, the problem we have here is, these banks just don't have enough capital to balance off these exposures. And that's what we're going to have to do. So, the question, is it a crisis of liquidity or solvency? From an anarchist point of view, we say, well, neither. It's a globalization crisis, because we want to resituate all of this, not just within the terms of economy speaking to itself, but as to the background of where it comes from, what it actually means in a political context. Slide. This one I just like. Slide. What's the relationship between globalization and this mess of shadow banking system, credit derivatives, and so on and so forth? We've sort of touched on it before anyway. These things have grown with globalization. As supply chains lengthen, as they go across borders and so on and so forth, it's not simply a question of a few greedy people have been using this thing to speculate. It's the legitimate, in quotes, uses that are really growing this thing. And these are the needs of capitalism in an increasingly international world, which is why you're getting people from as far as the Financial Times, Gordon Bloody Brown, and so on, saying, we need a world global monetary authority. Heart negre, eat your heart out. And, yeah. Right, and that's the final point, is one of the great ironies of these derivatives is that, of course, they're supposed to be about managing risk, as reducing risk and so on. And so for each individual participant, it makes a great deal of sense to protect yourself by buying these CDSs. However, the collective result of everybody following their individual interest in protecting themselves against risk is actually to create more risk for everybody. And this is basically what the CDS market has become. It's sort of the return of the repressed, if you like. And it is also, it's recognized by people in the industry that it's a Frankenstein. They've created some, you get headline things and papers going, my God, what have we created? How the hell do we get away from this monster? Interesting question. Slide. So, now, having looked at the nature of the crisis, that sort of informs us looking back at the origins of it. The whole official story here is that this is a little local difficulty of, those stupid Americans fucked up their mortgages. They lent money to people in black ghettos when they shouldn't have lent them money, and if it hadn't been for that, everything would be sorted. Bullshit. The background. It's not simply about the breakdown of the shadow banking system. The breakdown of the shadow banking system is caused by something. We have got a war going on. Wars are incredibly expensive. They're a big investment of capital outside the national borders. In this case, dollars. And of course, because the oil producers price their product in dollars, as America devalues the dollar by spending in its war efforts outside, they of course want to protect the value of their oil, so they jack up the price of oil. Because the way the crisis is currently presented to us is saying, like, how unfortunate are we that not only have we got a credit crunch have we got a crisis in the credit market, but at the same time, as if by magic, we also have an oil price hike. How unlucky! As if these things were not connected. And I'm not against coincidences. I believe in coincidences on a scale. I believe in small coincidences. I don't believe in global level coincidences. That just doesn't happen for me. So, again, the Greenspan put the thing. So this is a bit like, in some ways, Vietnam. In the 1970s, again, we had a situation where America was pouring, hemorrhaging dollars out into Southeast Asia. This was creating a crisis in the then existing Keynesian global world order, and eventually led to its breakdown. And of course, the oil price hike in 1973, again for the same reasons. But let's not get tied into that too much. Let's look at the differences between then and now. And really the differences between then and now is back in the late 60s and early 70s. Most of that stuff that the Americans, hardware-wise, were shipping to fight their war in Vietnam was made in America. The big difference is now, of course, most of the stuff the Americans are consuming and indeed shipping to Iraq and so on is not made in America anymore. And this is the big difference of globalization. It's also the background picture that between the end of the Vietnam War and the late 70s and the current thing, we have basically the largest movement of humankind in human history. That's to say, the movement of Chinese people from the countryside into the cities to become the urban proletariat. The urban proletariat has swollen from 1.5 billion to 3 billion, which means, congratulations, we are now finally the majority of humanity. But that's an enormous change. And part of that change has been the moving, just as the wars between Europe meant the focus of manufacturing, so moved from Europe to America. So now the final outcome of this power play means that now the focus of manufacturing has moved from America and Europe to a certain extent also to China. And that's the big picture. So, what next? Will the possible plan work? That's the question we're all asking sort of in the papers and so on and so forth. Probably not. Do we care? Not that much. The things that we know are happening anyway, global recession, major fuck-up, those things are going to happen either way. How effective they are at saving rich people's money, whatever. It's going to be a mess either way. So, it's not, for us, that's not a major important thing. Although I would tend to side much more with, like, the economists, like from the FT and Wall Street Journal and so on and so forth, who says it's not going to work, obviously, than with WM. What about regulation? It's what they're all screaming for these days. Which is lovely for those of us who spent the last 25 years of these bastards banging us over the head saying, regulation is bad. They're now saying, well, we could do a bit of regulation. Again, not our problem. Our problem is not to solve capitalism sort of issues. It's to see what we can make from them. Slide. Another gratuitous picture. Slide. So, strategy-wise, this SWOT analysis thing, as I say, it's an acronym for strengths, weaknesses, opportunities, and threats that you can do for yourself or you can do for your competitors. So I'm going to start by doing it for our competitors, if you like, in the big sense. So, for them, strengths, they're still in control, you know.
Just
SWP are plastering the town with saying, is this the end of capitalism? No, it's not. You know, seriously, guys. At the end of the day, when it's all on the floor, the rich will still be rich, and we will still be having to sell our labor for a fucking living, and that's the end of it. So, you know, let's not get giddy. Weaknesses. They have revealed serious structural fragility in their system. They can't even let one fucking bank go bust without threatening to drag the whole fucking system into an abyss. And this is what scared them. This is the 15 minutes away. This is the brown trousers fucking problem here. They didn't realize quite how badly this, you know, while it was all making money, it was fine and wonderful, aren't we clever? Now, oh my God, what have we done? Other weaknesses, ideological crisis. This is the end of neoliberalism as an unquestioned ideology.
Is it?
Yeah.
It is.
Heck, Paul, the Secretary of the U.S. Treasury says raw capitalism is a dead end. You know, it's everybody and his dog saying, well, we went too far, it's time for more regulation. The markets can't fix themselves. Hyman Minsky will eventually take over from Milton Friedman. The whole notion of the markets will fix themselves, the invisible hand will sort it all out, is fucked.
So monkey can die unhappy.
Well, as I say, that doesn't mean the end of capitalism in any means, because don't forget, before this neoliberalism was a Keynesian ideology. So we're not getting out of it that easy, but it is an unfreezing of the ice, if you like, cracking of the ice, which means that, you know, it's an ideological crisis for them, which provides opportunities for us. Because, you know, if everybody and his dog and so on is on the radio, on the TV, chatting across the fence about, like, is capitalism looking too clever, is it? Yeah, that provides us with an opening. So that's a weakness for them. Until they sort out what the next mainstream orthodox ideology should be, and that's going to take a bit of fighting, they're weak. Opportunities for them. Well, we can create this spectacle of incredible terror. Oh my God, the sky is about to fall on our heads. And maybe we can screw the pants off the working class and then grab their wallets. You know, every opportunity. I mean, Neumann kind of had one point, you know. Capitalists are very great at seeing opportunities in anything. You know, the bigger the crisis, the greater the opportunity. Threats for them. They're completely out of the normal game plan. They don't, you know, they are completely in uncharted territory. They don't know what's going to happen next. The likelihood, you know, most of the people in charge are not really there because they're super amazingly gifted people, right? A whole lot of the people, there are some amazingly super gifted people in there, but a whole lot of them are just average schmucks who happen to be there because they were born into it or promoted into it and so on. George W. Exactly. I rest the prosecution. So, you know, now they're in a situation where they don't know what to do next. The rule book doesn't, you know, is not particularly helpful at this stage. So they're scared that anything they do could create more fuck-ups, and as in fact likely. And the final other thing is, as well, as I say, is the big picture background is that the whole post-war thing of Europe having ruined itself in the world wars leading to the rise of the unquestioned hegemony of the US over the world, both financially and materially in terms of production and so on and so forth. that is disappearing. U.S. is hemorrhaging power, really is. Even little things like Georgia, for example, witnessed the loss of a NATO-secured corridor to the Caspian oil, for example. But sadly, none of these three wise monkeys here will be facing a jury or a firing squad anytime soon, so we still have to keep ourselves in perspective here. However, they could all be on the dole fairly soon. Right, for us. Strengths. We have strong association with the anti-capitalist brand. There's someone on the Anarchist Black Cat forum said, Radio 4 in England was asking on the feedback from why don't we have the anti-capitalists and anarchists say on this? Let's hear their opinion. People nowadays, anti-capitalists go like, oh yeah, like anarchists and shit, yeah. So much more so than people, maybe back in the 60s and 70s would have thought more of the Workers' Revolutionary Party or the Socialist Workers' Party and so on. So we have, for us, this opportunity gives us an opportunity. Our strength also, opportunities is down. Strengths-wise, we have critique. A lot of the commentary that's going on in the papers is people just repeating what somebody else just said. They don't really have any clear ideas. They went to university, listened to the standard procedure about mainstream neoliberal economics, went, yeah, okay, cool, God, this is boring. Wait till I get myself a proper job. So they have no ideas at all. Whereas the strength that we have is actually we do have critique, which is different from criticism. Anybody can harp about, how the evils of greed and the world and so on. Anybody can do that. But we actually have a critique, which is our great strength. Weaknesses, well, we're tiny. We have very little access to the mainstream media, although at the moment we have our own media, which we're working on, but still has very, very small penetration. Those are our weaknesses. Our opportunities. Huge gaping hole in capitalist ideology. It's a wide open target out there at the moment. The solution they're proposing, not only is it not addressing any of the problems, it's a blatant class robbery. To the extent that even a country that's fundamentally brainwashed into being anti-socialist and anti-communist as the states are going like, hang on, we're getting screwed here. So, great opportunities for us. Threats, obviously, the heterodox people, the neo-Keynesians, status re-regulators, be they the soft left, the floppy left, or whatever, will try and obviously seize the alternative space, push themselves in front of the cameras, and try and get hold of what we can do in the post-neoliberal thing. And it's for us to stamp them down, basically. Okay, slide. Right, now we're just into the pictures. This is how we get into this mess. Slide. I rest my case. Slide. These are American homes now. And this is great. We'll just say one little thing about this as well. Of course, all your hardcore sort of blowhard U.S. senators died in the wool anti-communists going like, this is socialism! And it's like, well, not exactly. Not unless Hitler and Mussolini were socialists. I think we should try and get that point across as well, because it is this thing that's floating around on the blogosphere and the internet, so I'm like, geez, I never thought I'd see the U.S. go socialist. It's like, well, actually socialism tends to involve the expropriation of the expropriators, i.e. redistribution from the rich to the poor, not from the poor to the rich. So that's
the Socialist Party socialism then.
that's
the 250 leading monopolies.
Yeah, well, they're doing it. I mean, militant must be wetting themselves. And I think that's pretty much it. Slide. There we go. All right, thank you very much for listening. Any questions?
I do, but I don't want to keep people.
Just like a comment I think there was really, really good and totally covered everything, and I thought it was really, very good indeed. One thing I think that's worth bearing in mind so far is that the crisis, I think, hasn't started yet, really. Like we're probably heading into, I think, at 10 years of capitalism being seriously depressed. And the reason being, it's not just the banks that did this debt leverage thing. Like that became the standard neoliberal model of all companies. That basically any capital you have, you try and you use that to get as much debt as possible. And what we see now isn't just basically is that debt has been a across the board reevaluation of risk. Everything is seen as riskier. Okay, so the economic model that made sense to have a vast amount of debt and you pay less tax and you just service that debt and you make greater profit from a smaller amount of capital, that just doesn't work anymore. And pretty much all the big American corporations in particular have balance sheets that are just enormously full of debt. So they might have a few $100 billion in capital, but they might have billions and billions in debt. That economic model is just broken for the foreseeable future. Those markets aren't going to be fixed. Like, nobody's even thinking that they're going to be fixed in any time soon. So what we're going to see over the next 5-10 years is these corporations trying to unwind, as they say, just get rid of this debt, which means cutting back, it means closing factories, it means economic shrinkage. And the other thing I think we're going to see as the United States in particular, I mean, this is going to happen across the world, but particularly in the US economy, that's going to happen, is they're going to have to finance that and at the same time fight all these wars, and they can't do both at once. So, I mean, they're just so expensive. However, that doesn't necessarily mean that we're in for good times. Like they're as likely to start striking out at people crazy. Like China is passing us out economically, or is catching us up. We're basically our economy is shrinking, but we still have a big army that's let's get them while we're ahead. So we are, I think, we have ended the period of 1989, the end of history and so on, and we are going to be into a much more turbulent period where there isn't a hegemony, and we have great things like Great Depressions and resource wars spinning up like here, there and everywhere.
Conor, I'll just take a few questions. This is quite late and people are wrecked, but I'll take a couple of them.
Just a really quick question. The Irish government thinks 400 billion. The American thing that was knocked down was 700 billion. And I know they're saying you'd never get all that 400 billion. The maximum might be 14 or 15 or something. Or the thing that interests me though is that the Irish government as well, including the Green Party, actually aren't just guaranteeing the deposits, but they guarantee the banks with their debts. And what they're guaranteeing them is all debts that the Irish banks have bought in. So they basically said, the Irish government, the first government in the world, say that the ordinary Irish taxpayer is going to carry a load of that debt for a whole load of banks all over the world via these banks. Or that's the way it appears to me. Just it's one of the maddest things I've ever heard in my life.
It's pretty crazy. I mean, they've basically nationalised the debt and the liabilities while keeping the profits private.
So we have to.
It just seems to me it's like all this money out there that isn't backed up by anything real or tangible. It's real because the emperor has no clothes, and now somebody has shouted it out, and they've all gone, "Oh fuck! What did we do? Why did you have to tell somebody?" Because we are heading into, I believe, a long recession, and it's going to be a fairly deep one. Because even if none of this shit had happened, none of it at all, if none of that had existed, we've been back sort of in the 1960s, 1970s when, you didn't have globalisation. Nation states could, to a fair degree, regulate their economies. Like, there was a time you needed central bank permission, I think, to bring more than 100 quid out of Ireland, like even on your holidays. So even if none of this happened, the rate of profit is falling because the way money chases after success and then it becomes more competitive, the rate of profit falls. And we're seeing it now, like, the current pay being proposed is a pay cut. 11-month pay increase in the public sector followed by a below-inflation pay rise. Below-inflation pay rise for the private sector. We're being hyped up for cutbacks in all sorts of services, like 1,000 redundancies announced in the HSE this week. In the HSE of all fucking places. And what we're going to get into is, like Paul was saying, all sorts of soft, wishy-washy liberal lefties are going to be coming up with all sorts of plans to sort of rescue capitalism with a human face. Now, I think it's a wonderful opportunity for us to just keep throwing around. It's your fucking system. You control it. You control it the way that you never have before. You've just shown that you just fucking, you shouldn't even be left in charge of a fucking playgroup, let alone an international economy. That capitalism has tried everything. It's tried sort of national economies, globalised economies, Keynesianism, neoliberalism, you name it, it's tried it. Even on its own terms, in terms of what it promises, hasn't got a fucking hope that, it puts us in the situation now where we can talk realistically about a completely alternative social and economic model without being seen as just sort of like a religious group that has got a nice idea. I think for the first time maybe in a generation that there's going to be a real opening there where people, all the things people took as certainties that were just natural they haven't been shattered, they're beginning to be shattered. And I think we find a far more and more receptive audience as long as we tie that critique in with people's day-to-day concerns, things like the pay deal and like health cuts.
Just really quickly, I'd say that on Saturday we were giving out the papers which had recession. Initially when the paper came out, I didn't think it was the best headline, right? But there was 6 or 7 of us giving out the paper, and I was there going, it's official, recession has come, now our chance to bail out the banks. Now, looking back on it, I look like a fucking prophet. I'm surprised I haven't met people since Saturday who want to follow me into some fucking strange dark alley in before work. But anyway, but little did I know. I was talking to a guy who worked in the bank today, and he said the amount of toxic shit that they have in the Irish bank system is phenomenal, he said. And this idea that they're just going to, be able to package it off and separate it out is complete nonsense. And he said the day it changed for them was the day that Beverly Cooper Flynn was held up as an example to them of what they should do, which is sell. We're all salespeople now. We're not bankers anymore. We're not talking about being good with figures and backing things up. So there was a distinct break in the ideological line as to what you did as a bank and what you do now, which is you became salespeople and you sold fucking credit to everybody. And the other thing is that I think is it provides a massive opportunity for us, because if we really go in hard with all our propaganda and hopefully get the radio show up and everything else, people are desperate to hear what's really going on. Because if you're listening to Moaning Ireland, you're not going to get a fucking clue what's going on, because you're being sold as this bullshit that's being labelled as maybe the Irish model will be a great, seen as an example of a great model, and other countries will come in and do the same thing. And exactly like Crossy said, 400 billion for a fucking island off the west coast of Europe, which is 65% of what the US are trying to sort out themselves.
So it's just $250,000 for each man, woman and child.
It's only twice general GDP.
Exactly, yeah, whatever it is, it's just lunacy. So people know that they're not going to get the answers there. So if we just keep flogging our message, I think we're going to have a very receptive audience, because people aren't stupid, not like the way Pravda treats them or RT treats them.
Without David pointed, I think that's really important. All that is, thanks, Paul, for all the work on that. It's all very concentrated. But in reality, it's actually very simple. It's a big fucking gamble. And the whole thing is built on a big gamble. I think our opportunity is that anti-capitalism, that the word anti-capitalism, the phrase anti-capitalism is out there and everywhere. What the fuck is wrong with, So there's a phase of capitalism has come to an end. Capitalism hasn't by any means. And that's an important point we need to make. I think it really is important that we talk now about the pay deal and about why it's so important now to have political organisations, trade unions, etc., to stand up for the working class, because we've been made to pay the fucking mess. So it's actually a really, really simple message where we will have trade union leaders and everybody else saying, shit, we've got to take this deal, it's the best we can get, we're lucky to have a job, we're lucky that they're not coming back after us for more. We've got to be given the message that, now more than ever, it's important that we have strong organisations campaigning on our behalf, because otherwise they're going to come and screw us over completely. The other opening there is, we sort of, I think Checks or yourself referred to it jokingly at the end, in terms of sort of being the Socialist Party version of socialism. Well, it's true, because if your version of socialism is to call for nationalisation, there it is. So it opens up that debate, which was sort of theoretical to some extent, even when we're talking about gas, the debate between nationalisation and socialisation and what's the difference. Well, now here's a really concrete example of what we mean when we talk about the difference between socialisation and nationalisation. And I think that's a really important point for us to make.